Good day, everyone. Thank you for joining us once again here at Seaford and Brew for our economic briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to review over the Fed statement last week, look at some of their projections, and then follow that up with some changes in that Treasury curve. So what did the Fed say? We know the Fed overall saw that the labor market remained strong, but that the growth of economic activity had slowed since the fourth quarter. So we see this overall slowdown. They also comment here that the recent indicators point to a slower growth of household spending and business fixed investments. So that's a pretty significant change from where we were in the fourth quarter and the second half of 2018. And with that, because of this slowdown, we saw that they maintained their target range for their Fed funds between 2.25% and 2.5%. That is something we expected. And they maintained their patient language in terms of what they see in the future. And we're not going to see any rate changes until they remove that patient word. So just keep that in mind as we move through the next couple of Fed meetings, and that word patient remains there. The bigger surprise, though, was their release of their quantitative tightening, and that coming to an end, and the process of which that's going to go through. Overall, in May of 2019, they will be reducing down their Treasury redemptions to that $15 billion mark per month from their current rate of $30 billion. So they're going to pull that off a little bit in May, and then in September, they're going to totally end their redemptions. And that's both on the Treasury side as well as the mortgage-backed side. And in fact, in October, they're taking that a step further, and they're going to push $20 billion of their mortgage-backed cash flow, those redemptions, into the Treasury portfolio. So they're going to increase their weighting to Treasuries beginning in October. So we got to keep that in mind and the impact that that's going to have on that Treasury market and the rates there. Overall, with their dot plots and their projections, maintaining that the current rate throughout 2019, maybe one rate hike in 2020, but even that's becoming a less likely scenario. When we look at the overall level of growth for GDP in their projections, they reduced that down to 2.1% for 2019 from their 2.3% in their December projections. Continue to see that slower growth, and they followed that up with 2020 at a 1.9%. And then in the 2021 category, it's at 1.8, maintain their projections as they were in December. Unemployment rate coming up a little bit in their projections, up to that 3.7 and 3.8, and then 3.9 in 2021. In terms of inflation, maintaining at or below that 2% target that they have. But overall, when we look at that impact to the Treasury market, we saw a slight inversion of the curve on Friday. This is looking at the Treasury numbers from the Treasury Fed or website. We can see 10-year Treasury at a 244, the 3-month Treasury at a 246, so a 2 basis point inversion, just slight inversions, but this could continue on. In fact, when we look at this, we've seen this chart in the past when we're looking at the inversion of the curve, typically followed by a recession once it goes below zero. And then what happens afterwards, once you hit a bottom there in the inversion, you can see we tend to have a pretty significant increase in that slope of the curve. And how does that happen? Well, if we look at both the 10-year Treasury and the 3-month Treasury going back, we can see that tends to happen because of reduction in the short-term rates. So we saw that short-term rate reduction in the past, which widens out that spread. So that's something to keep an eye on. And in the back of your mind, when you're setting rates for this year, looking at the growth in the loan portfolio, we're doing some investments, making sure that we reduce that exposure to that short-term lower rates. In fact, we look at this and we follow this up with the implied probabilities from Bloomberg in terms of where the Fed funds rate will be moving out in the next couple of meetings. And interestingly, look where we are here in January of 2020, looking at a 74% probability of a rate cut. That's much higher than we saw last week when we looked at this and it was 40%. In fact, when we look, there's a 50% probability of a rate cut in September of this year. So that's pretty significant, and we want to keep that in mind as we're reviewing our ALCO models and the impact of the reducing rate environment. Now remember, when we're looking at that, you want to make sure you're running a non-parallel scenario where we're seeing that the short rates come down and long rates staying about where they are, maybe coming down a little bit, but not as significantly as those short-term rates. You want to see how that scenario kind of maps out inside your ALM models. And that's what we have for you today. We look forward to talking to you in the near future. Have a great day, everyone.